Welcome to the deep dive. This week, we're looking at something pretty rare in the world of high finance, a real convergence of some major players.
Yeah, usually these big hedge funds are kind of battling it out, right? Different strategies, sometimes even betting against each other.
Exactly, fighting tooth and nail. But recently, we saw three really influential, high-profile billionaire investors all pile into the very same stock. That's unusual. Shows real conviction.
A coordinated conviction almost.
Right. And that stock is Nvidia, ticker NVDA. I mean, they're basically the king of the AI chip market right now.
Undisputed, really. Their value shot past, what, $4 trillion earlier this year, setting records? It's all about AI.
And the investors who made these big moves, we're talking David Tepper from Appaloosa Management, Michael Platt at BlueCrest Capital, and Philippe Laffont of Coatue Management.
Heavy hitters.
Definitely. And these weren't small buys either. These were significant moves made during the second quarter, like real statements.
Mm-hmm. And that collective statement sort of sets up our mission for you, the listener, doesn't it?
Yeah, what do we make of this?
We need to unpack this signal. I mean, when you have three people with track records like theirs making such a synchronized move, well, the question becomes, should you follow them? Especially into a stock some analysts think could hit, what, $10 trillion by the end of the decade?
10 trillion? It's a staggering number.
It really is. But maybe before we get into the weeds of this trade, we should touch on why people even pay attention when billionaires make moves like this.
Good point. Why does it matter?
Well, it's not just that they're smart, though they usually are. It's more about their proven ability over years, sometimes decades, to spot winners, to see trends.
Right. And they often have, advantages we don't. Access to maybe deeper research connections.
Exactly. And the sheer scale of capital they can deploy. It's not like you or me buying a few shares. Their decisions can actually move the needle. They see data sometimes before it becomes public.
Okay, and how do we even know they made these moves? That's the regulatory side, right?
That's the key. It comes down to the 13F filings. Because these guys manage over $100 million in securities, the SEC makes them report their holdings every quarter.
Ah, the 13F. So it forces them to show their hand, basically.
Pretty much. It's a glimpse into what the big institutions are thinking and doing. And in Q2, their hands all showed a big bet on Nvidia.
Okay, so transparency is good, but there's always a but, isn't there?
Always a caveat, yeah. Just because big fund does something doesn't mean it's automatically the right move for you.
Right. Your own situation, risk tolerance, all that matters.
Totally. You need to see if their strategy fits your style. Like if they're betting on some risky turnaround, maybe a cautious investor sits that one out. But here, well, this signal seems to be about massive growth potential.
Okay, let's talk scale then, just to give people a sense of the money involved here. David Tepper at Appaloosa, he manages around $6.4 billion in these 13F securities.
Oh.
Also owns the Carolina Panthers, interestingly.
Right. Known for big, bold macro plays.
Then Michael Platt at BlueCrest, that's Europe's third largest hedge fund, managing about $2.6 billion in 13Fs. And Philippe Laffont at Coatue, he's huge in tech investing, oversees a massive $35 billion in 13F securities.
$35 billion. Wow. So these aren't small operations.
Not at all. And now we get to the conviction part. How much of that huge capital did they actually put into Nvidia in Q2? The numbers are, well, they're pretty eye-popping.
Let's hear them.
Okay, Tepper. He was the most aggressive. He didn't just add, he increased his existing Nvidia stake by a whopping 483%.
483%.
Yeah. He ended Q2 holding 1,750,000 shares. That's now 4.2% of his entire reported portfolio, putting over 4% in one stock. That's serious conviction, especially for a macro guy.
That's a huge bet on the whole AI theme playing out through Nvidia.
Okay,
what about Platt?
Platt made a strong statement too, but differently. He started a completely new position, bought 649,956 shares. That's 3.9% of his portfolio right out of the gate.
Wow, so not testing the waters, just diving straight in.
Exactly. And Laffont at Coatue, he already held Nvidia, but he boosted his position by 34%, now holds over 11.4 million shares.
11.4 million shares.
And that makes up 5% of his enormous portfolio. So you add it all up. The message is pretty clear. These guys think Nvidia's growth story has a long way to run.
The consensus is definitely there. They seem to believe we're still in the, early innings of this AI-driven growth cycle for Nvidia.
Which forces the question, as you said earlier, why now? What did they see in Q2?
Well, the big picture is obviously the AI market itself. You hear analysts talking about it becoming potentially a multi-trillion-dollar market. Nvidia isn't just part of that market.
They're kind of essential to it. The bottleneck, maybe?
That's a good way to put it. And look at their financials recently. They've been posting incredible growth, right?
Wow.
Double, sometimes triple-digit revenue increases over the last few years. Record numbers.
Driven by everyone rushing to build AI capacity.
Exactly. Hyperscalers, big companies, they all need the processing power, and they're turning to Nvidia's GPUs, their graphics processing units.
Okay, but let me push back a bit here. Lots of tech companies promise growth. Lots of chip companies are trying to compete in AI. What makes Nvidia's position so strong, so defensible, that these billionaires are betting billions it will last? What's the real moat?
That's the crucial question, because it's not just about having the fastest chip today. Yes, their GPUs are top tier for AI, but the real lock-in, the deep moat, is their software ecosystem. It's called CUDA.
CDA. Okay, I've heard that term.
Right. It's their proprietary platform for parallel computing. They've been building it out for, what, over a decade now?
A long time in tech.
A very long time. And it's basically become the standard for AI development, for machine learning. All the major AI researchers, developers, the big cloud platforms, they're all building on CUDA.
So even if a competitor, say AMD, comes out with a chip that's maybe a bit faster or cheaper?
The switching costs are immense. Think about it. The whole world of AI engineers and data scientists would have to rewrite potentially millions, maybe billions of lines of code to move off CUDA. It's just not practical on a large scale quickly.
Ah, okay. So it's sticky, really sticky.
Extremely sticky. So as companies need to scale up their AI operations, which is the big trend happening now through the end of the decade, they naturally turn to Nvidia because it's the established, powerful, integrated platform. They're not just selling chips. They're selling the essential infrastructure the digital economy is rebuilding itself around.
And that's why we hear those huge market cap predictions, like $10 trillion. It's based on that platform dominance.
It's based on the idea that their platform becomes almost like a utility for AI compute.
Got it. Okay, let's circle back to the timing. Q2. These guys bought in Q2. The suggestion is they got a good price, maybe took advantage of a dip.
That seems very likely. It looks like they caught what some described as a dirt cheap moment for Nvidia.
Dirt cheap. Okay, what does that mean in terms of numbers?
Well, at points during the second quarter, Nvidia stock was trading for less than 24 times its forward earnings estimates.
24 times forward earnings. Okay, help me out here. For a company like Nvidia, center of the AI universe, is 24x high, low, average?
It's incredibly low. Forward earnings basically tell you what investors are paying today for each dollar of profit expected over the next year. For a super high-growth tech leader like Nvidia, trading under 24x is, well, it's a bargain.
What would be more typical?
Oh, for S&P 500 tech, maybe closer to 28x, 30x on average. And real growth darlings can easily fetch multiples of 50x or even higher. So 24x was definitely an anomaly.
Any idea why it dipped like that in Q2?
It seems like it was mostly broader market jitters. Worries about inflation, interest rates may be going up again, just general uncertainty. That caused a bit of a pullback in tech overall, some profit-taking.
And these billionaires saw that as just noise.
Apparently. They likely recognize it as temporary market sentiment, not a fundamental problem with Nvidia's story, and they used that moment to buy when it was briefly priced, more like a regular tech stock than the AI leader it is. Smart institutional play.
Brilliant timing, really. But okay, that was Q2. What about now? What's the reality check for the listener today? Is it still cheap?
No. The dirt cheap window definitely closed. The valuation has climbed back up quite a bit since then. Now it's trading around 40 times forward earnings estimate.
40 times. Okay, so significantly higher than 24.
Definitely higher. So it's not the bargain it was back in the spring, but, and this is maybe what the billionaires buying still tells us, even at 40x, it's actually still cheaper than it was at its peak maybe a year or so ago.
Interesting.
And their buying actions suggest they believe the growth potential justifies paying this higher multiple. They likely think the future earnings driven by CDA and the AI build-out will grow so fast that the company essentially grows into that 40x price tag relatively quickly.
Which leads us right to the big question for anyone hearing this now. FOMO. The fear of missing out. If the smart money bought at 24x, is it too late for you to get in now at 40x?
Look, it's a valid concern, but thinking purely short-term like I missed the absolute bottom is rarely the path to investment success.
Right. Investing is long-term.
Exactly. Real success usually comes from buying quality companies with strong prospects and holding them for the long haul. Think 5 years, minimum. You want companies that can deliver substantial gains over that kind of time frame.
And Nvidia's growth story seems pretty solid on that front.
Well, given the structural demand for their platform, the CUDA lock-in,
Hmm.
yeah, the long-term story seems about as strong as you can get in tech right now. So missing a temporary dip shouldn't necessarily deter a long-term investor if the core thesis remains intact.
Okay, but what about position sizing? Tepper and Laffont put 4 or 5% of their billions into this. Should an individual investor mirror that kind of concentration?
No, definitely not. That's where the caveat comes back in strongly.
Right, risk management.
Absolutely. For you, the individual investor, Nvidia looks like a solid potential investment, whether you're cautious or aggressive, provided it's part of a well-diversified portfolio. Use the Billionaire's move as a signal of confidence in the company, but don't copy their massive concentrated bets. Build a balanced portfolio.
So, summing it up then, this coordinated move by Tepper, Platt, Laffont. It's a powerful signal. It shows deep institutional belief that Nvidia is positioned to be the key winner from this massive AI infrastructure build-out.
Yeah, it's like a unanimous vote from the top tier saying, this company provides the essential tools, the picks and shovels for the AI gold rush, and you need exposure to it.
They see the shift to AI as structural, not just a cycle.
Exactly. Permanent and transformative.
Okay, so let's end with that provocative thought from the source material. If that prediction holds any water, Nvidia heading towards $10 trillion by the end of the decade, just imagine the sheer scale of computing power that implies.
It's almost mind-boggling.
Right. So if that happens, what does that kind of relentless demand for compute mean for everything else? For the global power grid, for building massive data centers, maybe in places we haven't even thought about? Which other sectors get totally reshaped by this fundamental need for more and more processing power?
That's the bigger ripple effect, isn't it?
It is, and that's something for you to think about until our next deep dive.